see you around the timeline. Feels good to be back.
I think that Rollup is one of the most premier media brands in crypto, and Andy and Robbie are great experts at everything they talk about, and it's my favorite podcast.
Adding it to my library as we speak.
Potentially multi-chain deployments.
We are at DevConnect Day 1 here. I'm with Jesse from Base. JP Morgan, BlackRock, DTCC, Fidelity, the entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
He said it, he finally said it.
I'm so bullish.
Andy's bullish, I'm bullish, we're bullish. Headed to the top. If we're not already at the top, we're going to the top.
We're going.
Rollup is my favorite.
From all walks of life, all over the world, all over this industry, come together for the Rollup.
Zoom out. The institutions aren't coming. They're simply here. It's the golden age of crypto, guys. Get right. Let's go.
Welcome to the nest. See you on the show.
Yo, Robbie. Druckenmiller bought my bags over the weekend.
Andy Druckenmiller.
Andy Druckenmiller. Robert Tudor Jones accumulating
Yes,
in
sir.
a DCA strategy, buying more Bitcoin. I saw that tweet on Friday night, Soho House, after with the guys hanging out. We had a couple clients roll through, some other friends. Had a crazy night with these three guys who are selling pre-IPO blocks of different companies. Like, not like a big like party night or anything. It was more just like, it felt like an episode of The Big Short in real life. I'll tell you more about it. But yeah, man, what a good weekend for the coins. How was your weekend, man?
Well, weekend was fantastic. Felt like it was nonstop, just moving around, getting things situated and settled.
Yeah.
But overall, man, I mean, plenty of things are happening. It's wild how market conditions, I mean, were apathetic going into the weekend. Felt like we were getting news. Now things are looking a little bit better. We'll get into markets in a little bit, but pretty green across the board.
Definitely.
I mean, man, thesis is unchanged, but it feels like every day we draw closer and closer to the start of a new cycle.
Agreed, guys. As always, you're watching the Rollup live from Tokenization Tower, the nest powered by our friends at Plume. Let's give them some love here at the Empire State Building, 77th floor. Absolutely epic day. Started off a little cloudy, a little rainy, but it's beautiful. Today's August 17th. We have a great show. Today we've got the co-founder of Rain, one of the largest stablecoin card companies. They're powering all of the favorite stablecoin cards companies that you guys know and love. Markets and weather, as always, tons of news, coverage to go over. And yeah, guys, I mean, I sat down this weekend with 3 guys selling large block shares of OpenAI, Anthropic, Kalshi, Atoms, and it is insane what is happening in the secondary market for these pre-IPO equity companies. They're going out, the GPs of these large venture capital firms are selling or are authorizing the sale of a certain amounts of their equity shares. Then you've got like these middlemen sharks, like these guys, and they're going out there and they're pitching these things to anyone from a New York Jewish billionaire who literally owns half the block to an NBA star. I mean, it is insane what's happening. We're talking hundreds of millions of dollars of size into Kalshi at like $30 billion, into OpenAI, into Anthropic, into a lot of these companies, SPVs, multi-layered agreements. You know, it's just like, it felt like an episode of in Big Short when they're like, wait, why are they bragging? And they're like, no, they're not bragging, or whatever that scene was. And like, not in a bad way. Like, these guys are great. Like, they're doing good work. They have, they're doing things right and they're making good cash. But it's just like the amount of craziness that is happening from the demand perspective of like, anybody with any amount of capital who missed investing in any of these early AI companies is going on a limb to get exposure to the extent of tens and hundreds of millions. So if you're wondering why crypto is not doing so well, Rob, or why things have kind of slowed down, I mean, I think a lot of that speculative energy is happening in behind the scenes meetings with literal whales and then young guys like ourselves, age 20 to 30, who are effectively operating as like middlemen for these GPs of these large, Silicon Valley VCs, trying to go out and get a bunch of buyers for these blocks, is what they call them, of shares. So yeah, I mean, like, they got, Joel Embiid's agent calling them that night. He's trying to get into the Kalshi deal, but they're blocking him out because they've got the deal's almost done with the son of, insert billionaire here. And it's just like, these guys are just like on the phone. Like, these guys got like 6 WhatsApp calls in a matter of like 2 hours at Soho House. And it was all just, it's just nuts. So.
And it's their shares, or they're brokering the shares for another client?
They're like drop shipping the shares.
So they don't own the shares. So,
No.
so there's some early OpenAI or early Kalshi employee that has a bunch of
GP
equity,
of a VC.
and they're looking to block trade OTC in the private markets.
Yeah, the
to
GP of the VCs that invested in them earlier on.
Yeah. Early
Crazy.
employees or early VCs.
Yeah.
And I mean, look, that's exit liquidity, man.
I know, it
happens
was
all
crazy.
around us.
It was crazy. And I was just telling him, I was like I got Anthropic at like $300 billion on my desk. And it wasn't that interesting because I was like, what is my 25K check going to do at your $300 billion valuation? Well, I mean,
Well, it's going to 3 or 4x.
they're looking like they're going to launch at $2 trillion. Yeah, I know, right?
So, I mean, for a $25,000 check, maybe you're looking for a bigger multiple. But these guys that are at hundreds of millions, if not billions of dollars of size, 3 to 4x is phenomenal.
Yeah. So that happened, and that was interesting, and that kind of like blew my mind. I was like, damn, like, so the business model is just finding whales, pitching them on buying this stuff, and then taking a little spread and just rinsing, repeating on all the big name companies that are launching, all the humanoids, the space companies. And it's all about the network, right? It's all about who you know. It's all about what, who you can sell to. So yeah, it was crazy. And then I spent the next 2 days absolutely on the couch because I ate too much dairy at this stomach bug. So I'm back now. I ate nothing but bagels and crackers and soup yesterday. This morning I also had a bagel with butter. But I thought I was over this stomach thing, and then I literally was on the couch, and I will not even explain what else was going on because of my stomach.
Well, I'm glad
and I eat dairy and fried
you are
chicken.
Certainly back in New York, aren't you, with all these bagels?
It was terrible.
Welcome back. Welcome back.
So that was what you missed at Soho House Fridays, man. Natan was there, had a great time. Yeah.
Well, we've got a lot to cover today, so why don't we get into it? Plenty of news. Today's topics, we've got, as you mentioned, the Rain co-founder headed into the Tokenization Tower.
Yeah.
Had a great chat with Hasib while you were gone. Talked a lot about Rain. And Rob from Dragonfly has also been talking quite a bit about Rain. So I think
they're
got
bullish.
Plenty of material to go through with the co-founder of Rain. Before we get into all of that, why don't we get into our pre-show role here?
Yeah, markets, weather, and more, guys. Let's get into it. Starting off with Denari, a quick shout out for them building infrastructure for tokenized U.S. equities, bringing real-world stocks on chain. Visit denari.com to learn more about on-chain access to public markets. It's a nice, pretty, beautiful 79-degree day. It says heavy rain out there, but it's not. I walked about halfway to the office this morning. It was perfect. Nice cloudy breeze out there. Feels like 83. Office isn't too hot. It's great vibes. I'm sure it's kind of warm down there in Florida, but you know we're doing our best here. So
looking good. Let's get into the markets. That's what I think everyone wants to hear about. That's what we want to talk about.
Yep. Before we do, let me tell you about Frax, our leading stablecoin partner of the show. Open, stable, borderless, future digital money. Visit frax.com to learn more about their FraxNet product and more. As we kind of get into what's happening in the market. I see a lot of green in the market today, guys. For all you guys watching, good morning. Good morning. YouTube, RX, show us some love. Let us know what you guys are buying, what you guys are selling, if you guys are holding anything, if you're trying FOMO, if you're trying Pump Fun app, if you're long, short, memory, stocks, crypto. Rob, what are you reading today off this green day?
I mean, look, I love to see it. We've been talking about this for a while. It feels like at this point it's still chop, but look, disbelief rallies. This rally will fail like all the others. It just takes one, right? It just takes one of these little pops to catch a bid, to get sustained. And you know how much, I'm sure you saw this because I saw this all over the timeline over the weekend, which was that open interest is going up. That means that people are betting on volatility. They're expecting this market to move one way or the other. And we knew that volatility was at all-time lows. Bollinger, I mean, you take your indicator, just by looking at what was happening, the volatility was at all-time lows. So we knew that this was an unsustainable market situation. We knew that volatility couldn't stay this low forever. We knew that this thing was going to have to move one way or the other at some point aggressively. It's moving up now. We don't know if this is going to be a sustained rally, but it only takes one for this to ultimately move and catch some momentum. So it's good to see. Obviously, we want to see, this just apathy turn into a sustained rally upwards rather than, the one last leg down. Also, it just seems like we're not going to just stay in this low volatility environment for the next month and a half. Everyone's calling October as the time frame for when we're actually going to see a move. I think it's going to happen sooner. Maybe this turns into a sustained rally. That would be incredible for the vibes. But as of right now, we're still in chop. I mean, I don't really feel comfortable in calling this a sustained rally until we see, something more than 1 to 5% moves across the board.
Yeah, I mean, we need an expansion from Bitcoin for sure. Equities are strong as per usual. The memory basket, I think, is bottomed out. If you look at DRAM, the memory ETF, it's up 7% today. Let's see. Yeah, it's at 62 almost. Bottomed at 44 only 10 trading days ago.
There are things, just kind of diamonds in the rough. Like I shared my portfolio last week. I mentioned that I still had some
ripping.
Pump funds ripping. We had G Money on talking about fake world assets last week.
That thing's ripping.
30% plus.
I top blasted that on FOMO, guys. If you guys follow me on FOMO, I am just top blasting into fake world assets.
Mr. Duca top blasta. I bought when it was down 15%, but now it's up. I still want to buy more. I want to get to a point where I have 1 million FWA in case this thing runs to $1.
In case we get $1. What's
$1 per FWA, which would be which would be $1 billion market, fully diluted.
So you
It's
want
got
like a 30, you want to get like a $30,000 bag at this current price.
exactly.
Bullish. Wow.
That's FWA.
If you do that on FOMO, if you run 30K to a mil on FOMO, bro, you will have 50,000 FOMO followers, like easily. Your Twitter account will 10x.
Well,
Just run it on FOMO. Dude, just run the whole trade on FOMO.
I'll tell you right now, I'm about a quarter of the way there.
There you
about
go.
25% of the bag that I'm looking for on fake world assets. I mentioned last week portfolio update. Obviously, you and I are both bullish on the monetary premium assets, Bitcoin and Zcash.
Yeah, doing well. Zcash looks great. It broke out of that little triangle thing that it was stuck in.
The revenue meta, we pulled up that net token values dashboard.
Yep.
Chainlink was towards the top.
Chainlink's
no
ripping.
surprise that it's ripping today.
Yep.
Ripping. I mean, it's up 2%, but it cleared that $9 mark pretty handedly.
Yep.
And there's a couple other ones that are just starting to turn on value accrual to their token.
Yep.
Syrup. I got like 3 updates over the weekend from Coinbase that said Maple is up 5%. And I got that
It's
update
got
like
ways to go.
3 different times. So definitely got a ways to go, but these things are starting to move.
How about EtherFi, guys? I put out that tweet that was like, this is one of our portfolio companies. I think our entry, if you guys look at the price wise, is like 20 cents, 22 cents. So back in the day, that was $200 million market cap. That's what it still would have been FDV wise, which isn't that great. I think the seed round was 40 or 50 or 60. So we got in at like a multiple of the seed round, right? We were kind of late on it. Thing launched at like 8 billion and then completely just got nuked all the way down. We had our vesting start, it launched March of 24. So we had our vesting start pretty much at the exact bottom at 55 cents. Then it ran up to like $2 and we didn't sell anything. And now it's back to 50 cents. That one looks really good still. And then how could we not say, Druckenmiller has literally bought PURR, the hype that I've been underwater on for a long time. Almost. I love following Andy on FOMO. Yeah, new type. You should, man. It's fun. I'm telling you, if Ravi does this fake world assets trade from 30 bands to a mil over next cycle on FOMO, guy will be goated in the trenchers will respect him.
Can I deposit the position that I already have?
For sure.
Okay.
For sure.
Right. Well, let's run it up.
Yeah, dude, for sure.
Might have to do that.
My FOMO, I just deposited more on there. I think I have 1,000 followers now on FOMO.
Okay.
995.
All right.
I'm down 20% on my fake world's assets bag. I'm up 25% on Black Bull.
Okay.
I actually low-key think that people are going to regret not buying Ansem. I think Ansem is actually, I'm actually so down just to be like, you know what? Pack up couple bands, 10 bands on Ansem, whatever it is, and just let the man grow to 4 million followers.
You saw
this
the Z500 thing this morning?
Yeah, he just launched it.
So obviously we had the N7 index for a while, but the issue with the N7 is it wasn't investable. You could go and buy all these tokens separately, but Z500 sounds like you
investable.
can. What's that?
We could have made it investable by putting it on a index app or whatever.
Right.
Yeah.
Right. And so Z500 sounds like it is, this on-chain index product.
Yes.
And Ansem is going to curate that index,
Yes.
right? Which is
And people launch tokens and they airdrop the tokens to Ansem holders.
Right. And so
he's kind of trying to he's trying to validate what he thinks is worth Ansem holders holding and rallying behind versus other stuff.
Yeah, so there's definitely a curation aspect, right? Where it's not just curating content, but you're creating an index of investable assets. And I think that's incredible. And I think that is kind of the first layer of this. And then you're right. The second layer of this is that there's tokenomic alignment between the index itself, all of the assets in it, and Ansem holders. Ansem, the Black Bull, becomes this meta asset of the index where you have value accrual. If the index does well, you have value accrual to the Black Bull token.
Yes. And I just want to give a shout out to Rasmer because I saw Ansem quote tweet him. And I know he's been the butt of a lot of jokes, but he's up 200 bands in public on Black Bull on Ansem token. And I just think the guy's hilarious. And I think he's just got a funny stream. And I just think that he's going to hit for multi 6 figs on Ansem in public. And it's going to be hilarious. And I just think Ansem to a bill is almost written in the stars. It sounds silly, Sounds silly, but it's like,
I mean, dude, when you think about previous cycles, Dogecoin, Shiba Inu, Pepe, Mog, like you get mega runners.
yeah. Let's see you buy ore on FOMO. They're still making good revenue. Yeah, I think they are, new type. I think they are. I mean, I couldn't be more happy to have woken up this morning to see Druckenmiller's aping on my PURR bags, contributing to a lot of growth and more. Zcash looks good. Pump looks really strong. Chainlink. So, yeah, I mean, we'll see, man. It's nice to see some strength, but nothing to really get too excited about. I do think there is something to be said about making that FWA trade in public on FOMO, though. I think there's a lot more upside than there. I mean, there is some downside to doing things in public. But I just made my FOMO completely separate, and I've only funded it through like Apple Pay and no like sending over from other private wallets and stuff. So
right. Well, FOMO and this Z500 and some curated index and the thesis that Thread Guy has been putting out there for a long time, they all feel very, very aligned and comprehensive, like very similar in the sense that this is all social trading. Yeah. This is all like investment curation. Like, you know, Thread Guy says the new influencers are going to be, you know, these people that, you know, basically make trades in public. Ansem is saying like, hey, this is an investable asset. He's curating this asset, this index asset. And then FOMO is saying, hey, like the assets that you buy in public on this app basically are this curated index of like your performance and your thesis. So all of these theses, I mean, generally when you see convergence and confluence amongst like multiple parties, I typically think that means that there's more truth.
But it's also just crazy though. Like I said, if this trade goes well and FWA like quadruples from here, you're sitting on like 100 bands in public of that. Like, dude, for an average 27-year-old to just be sitting on 100K of like a crypto token is just like unfathomable to the world, right? Like the majority of the world, to have $100,000 is like a massive accomplishment. I mean, let's just be real, right? $10,000. And so there's also an element to this of just like how, I mean, it's just, it's kind of like building this, that's almost like this like on-chain flex as well. But I worry about the whole like putting a target on your head and invasion of privacy. And a lot of the OGs would never want to do anything like this. But I think there is something to be said about like the whole, I mean, like the whole thesis is like the soft influence is declining and the hard results is what matter. So I'll leave you with that as I set up Charles here. I know you have news and more to cover. As always, our digital assets market is powered by our friends at Zama. Let's give them some love. Great Monday opening for the boys and the girls out there. Let me quickly tell you about Near, and then I'm going to pass you over to Rob while I get Charles set up here in the tower. Near is our partner for discovering and using apps on chain. Near.com, one account, no borders, your financial life, all on chain. Been using them to trade perps. My pump long is cooking. My lighter long is in the green. We are doing well. Near.com. Perps are great. Try it out and be back soon.
All right, guys, we're going to get into the news for today. First up, this was some news that dropped over the weekend, big in the payments and AI world, which is that Stripe, the big payments giant, still private, is going to be entering into an agreement to acquire OpenRouter. Funny because the same founder of OpenRouter was founder of OpenSea, which was obviously the NFT aggregator and marketplace. OpenRouter is a similar aggregator marketplace, but for AI. It will route your LLM queries into a, you know, basically this machine that is going to route your queries into the best model for that. Different open source intelligence or open weight intelligence models, as well as some of the more frontier models. And so, startup that helps companies switch between artificial intelligence models. The thing is that they're acquiring these guys for more than $7 billion, which is a massive increase on their last valuation. And so we are monitoring this mostly from the AI world. But we do think that, you know, Stripe doing this puts them in a very interesting point because this isn't really their game, you know. Maybe it would have made more sense for, you know, Anthropic or an OpenAI or Frontier Lab to acquire OpenRouter. But it's interesting that Stripe typically a payments company, has gone ahead and, seemingly made some moves on making this acquisition. So we're gonna keep an eye on this because it is going to fit a little bit differently into their tech stack. So we're gonna continue to monitor that situation. Nevertheless, very, very interesting to keep an eye on. Let's go ahead and move forward here. Our friend of the show, Frank Chaparro, Harvard is leaving their Bitcoin ETF stake untouched in Q2 after cutting it 43% in the prior quarter. So they cut some of their losses. Harvard is staying in the Bitcoin ETF position. Look, I mean, we know that this is something that is the next new unit of liquidity for Bitcoin. We've already gone into the individuals. A lot of those guys have gotten shaken out. El Salvador, some sovereigns, right? Different ETF providers, all of that has now rolled out. This product has been out for a long time. And we saw that it was actually, I think it was Eric Balanchunas, the ETF reporter from Bloomberg, who made this point, and I agree with it, which is that JP Morgan getting into the Bitcoin ETF, having some on their balance sheet, not particularly interesting. Having Harvard, right, these different pension funds, these things are particularly interesting because that is what those are sticky units of liquidity, and that's what we're continuing to monitor. So we're gonna keep an eye on this, but at the moment, it seems like Harvard is just keeping their stake where they are, and we're going to see how these positions evolve over the coming weeks to months. Big shout out to 1inch as well. Launched their shared liquidity protocol. They are crushing it. Very innovative when it comes to this technology. And we are going to continue to keep an eye on this as well because the DEX space is heating up, AMM space is heating up. We're going to continue to take a look at this space. 1inch lets you keep your money in your wallet, but also provide it as liquidity to these pools. Very fascinating mechanism to take a part of. Let's keep going. Paul Tudor Jones is adding to his Bitcoin position, and Druckenmiller is buying Hyperliquid. Have a great weekend. This was incredible news. Obviously, these guys tend to be right in the market. People like to follow their thesis. And so to have some of the smartest minds in the space tracking what we've been tracking for a long time is very cool to see. So Paul Tudor Jones investment increased its BlackRock Bitcoin ETF position by almost 20% in Q2. And, typically we find out about these changes at the quarterly filings. Tudor now holds almost 700,000 IBIT, almost $20 million. Honestly, kind of pennies if you're looking at the grand scheme of things, but still material. And then Druckenmiller going into PURR, I think was actually more interesting because this seemed to be a new position. So 23 million position in PURR, and obviously PURR is bringing Druckenmiller exposure and hype. And so these are guys that have typically, they've gotten involved into the digital asset space in the past, and now they are making larger positions and bets in the space. So very, very cool to see. Losers average losers, winners average winners. So that's what we're seeing Tudor Jones and Druckenmiller do. Just some absolute legends in the space. Let's kick it over to another friend of the show, but a little bit more of a controversial one. Mark Zeller, commenting on VVV, Venice, says he is passing on VVV despite viewing Venice AI as a strong privacy-focused and uncensored AI product. I think we've seen this in the past. Protocol and structure are different from product. He compares Venice favorably to competitors like OpenRouter, but argues the investment structure matters more than product quality. And so the equity token split is something to take note of. Venice recently raised 65 million Series A at $1 billion equity valuation. Keyword there is equity, because equity investors are going to receive exposure to strategic assets like GPU infrastructure, whereas the token, the VVV token, now offer staking versus AI inference, revenue, buy and burns, and yield, but no governance or ownership claim on the company. This is the equity labs to token split. Zeller sees this as an example of tokens being structurally subordinate to equity. And this is what a lot of companies that have launched tokens are going to continue to need to figure out. Lesson is that token value capture matters more than narrative, especially in these apathetic market conditions. Token fundamentals are what drives some of these tokens upwards. You see this with Pump Fund, with Lighter, with Hyperliquid, and now increasingly more of these tokens are starting to accrue value via the revenue that they're generating. But in this case, Zeller points out that there is still a divergence between the Equity Labs Corp, the equity ownership over some of this GPU infrastructure, and the revenue that is going into buying and burning VVV. So look, this is what almost every company that has both an equity corporate structure as well as a token, they're continuing to face this. This is an unsolved problem. We know this is a result of Gensler era regulation. And unfortunately, he has left a stain on the industry that the industry is still figuring out. Let me tell you guys about a partner of ours that we think is doing things the right way, keeping the crypto ethos in mind, launched their token a little bit more recently than the Gensler era, and that is going to be Zama. Zama is doing incredibly well with everything on the privacy front. We believe that AI is just continuing to take over more and more of the world, more of the attention market share. Companies like Zama and Zcash are doing incredibly well because they are positioned for privacy, to shield assets and maintain confidentiality. We think, a dollar on chain tends to stay on chain, and a dollar shielded tends to stay shielded. You guys can encrypt your money at app.zama.org right now. Product is live, token is live. Next thing we want to talk about here today, Iran begins laying mine to the Strait of Hormuz. This is reported by CNN. Look, we don't know how accurate this is, but there has been slower traffic in the Strait of Hormuz. Guys, this is the last tweet from DB. It's been 5 months since we heard from him. He's been active since 2014. RIP. Don't have a lot to cover here. Look, DB does good news, but, obviously this was a while ago. So we don't know exactly what is happening on the DB front. We hope he comes back because he's been a trustworthy figure in the space. But best of luck to our friend DB. Let's continue to move. Got lots more to cover here. There's an L1 value capture thesis that we're going to get into. And so if you're curious, let's go ahead and cut to it. If you're curious what Toli is talking about in this tweet, and you run the numbers here, billion transactions per day at 0.3 cents per transaction, that's going to equate to about $1 billion in value capture for an L1 that is providing block space for these transactions to the tune of $1 billion per, or 1 billion transactions per day. You're looking at about $1 billion in revenue a year. And we know this is, a pretty valuable company. Look, if you look at some of these frontier model companies, they have unprecedented growth, right? And these are kind of apples to oranges at this point. I think Anthropic is going to do $100 billion of revenue this year, putting them in the camp of probably $1 trillion market cap. Whereas some of these L1s are on track to do $1 billion in revenue, putting them somewhere in the 10 to $100 billion market cap range. But we still have open questions about how we get there. You also have L1s that are scaling beyond this 0.3 of a transaction cost per transaction. So ultimately, look, if you have blockchains that are continuing to scale, they can provide supply at, orders of magnitude more affordably than what you're seeing here. There's going to be companies that take that block space, especially on L2s and whatnot. But if you do have this supply-demand dynamic work out, you're looking at about $1 billion per day. Toli seems to think that's a reasonable projection. So guys, we're going to go live from the Tokenization Tower with the co-founder of Rain. He is ready behind the scenes, as well as Andy. We're going to bring him up in just a moment, and then we're going to get back to finish out the news, talk about our daily equity segment powered by Denari, and everything else that is happening that you guys want to make sure you're keeping track of this week. Stay tuned right now. Co-founder of Rain, Charles Yoo-Naut, in the Tokenization Tower right after this.
Welcome back to another episode of Stabled Up, our premier weekly show covering the ins and outs of digital dollars, stablecoins, and the future of decentralized finance.
The show is made possible by Frax, and Frax is powering the financial engine of the internet, powering FRX USD and Genius compliant stablecoins. This is the stablecoin super cycle made possible by Frax. Now enjoy Stabled Up, our weekly stablecoin show.
Alrighty, guys, welcome back to Stabled Up, episode number 46 with the Rain co-founder Charles Yoo-Naut. Charles, great to have you in the tower, man.
Thank you for having me.
Yes, sir. As always, Stabled Up is powered by our friends at Frax. Visit their Frax.com to learn more about FRX USD and more. Charles, the leading stablecoin infrastructure crypto card provider, some would say. Obviously, there's been an explosive growth. I'm a big fan of PaymentScan.xyz, a great provider of data where you can see all of the growth of these individual neobanks. So a lot to cover on this kind of explosive growth, but maybe just quick into why Rain, why start this now? What kind of give us a bit of the founding story of the company.
Yeah, me and my co-founder Farouk, we met in 2021. Kind of in the depths of COVID, we met on a Slack channel for other founders and started working on a side project together, not related to stablecoins or crypto, but through that experience, we got really frustrated with the rails that are available to us as builders in the US. We were trying to build on top of ACH and Wire, and they were difficult to access. They were slow, they were expensive. It felt like 2021 that there had to be better options out there. And then that was kind of our first foray into stablecoins. It was adding stablecoin support to that fundraising platform we were working on. And then through that is when we got really excited and bullish about stablecoins. We realized that the actual experience of investing in a startup and getting an investment was way better on stablecoins. Like our first angel investment happened on Christmas.
Yeah.
When banks traditionally would have been closed, and then the weekend would have followed or banks still would have been closed. So it probably would have been 5+ days until we actually got the money. And the investor was actually in Singapore, so it could have even been longer. But extend USDC, we got it instantly. So that was one of our first aha moments of okay, this is better way of moving money globally. And we started to actually decide to work on Rain around that time. So that was November 2021. Really early on, we realized that the actual bottleneck to growth and adoption of stablecoins was that spendability, the interoperability with existing rails. We got the USDC that Christmas Day, but what we could actually do with it was really limited unless we went and off-ramped through an exchange and followed all of these different steps. So we realized if we can make stablecoins spendable on a Visa card, we unlock adoption and acceptance at millions of merchants globally, and that instantly makes stablecoins more valuable. So that was the first thing that we started Rain to tackle. And in 2021, we couldn't really have started as an infrastructure provider. If we started as, hey, we're going to allow you to launch a stablecoin backed card, we would have had 0 customers that day.
Right.
So we were actually our own customer in that we solved for the people that had this hair on fire problem early on. And one of those people, those early adopters, were crypto native teams.
Yeah.
So we built for DAOs, we built for crypto native funds, we built for protocols, and we're this B2B neobank for what was essentially an underbanked population at the time because of regulation. A lot of them were offshore where there wasn't really this vibrant fintech ecosystem. So we were the neobank for those people. And then through those first 2 years of building Rain is when we were able to develop all of our on-chain infrastructure, our smart contracts, our licensing, our Visa membership. And then in 2024 is really when we started opening up and becoming a platform and enabling other people to issue on top of the infrastructure we had developed. And from 2024 to now is been a lot of growth and excitement. We now currently power over 200 programs. We just announced our Western Union partnership recently, which we're really excited about. And having such a storied institution work with us, it's really a full circle moment for us.
Yeah, definitely. And I mean, we were talking prior to the show just that it feels like Rain has gone through like its first kind of exponential hockey stick growth, and that as an investor would say, like the easy 10x has passed. Now it's like the how do you 100x this over like the next decade? And I think we'll get more into that and kind of what you see there. But I think to kind of set the foundation further here, based on how you guys saw the opportunity right in the earlier days, this kind of neobank craze or mania, if you will, that has kind of started to really catch fire the last 18 months. As you said, it wasn't really a thing in 2021. I mean, there was the Crypto.com card. I was an avid user of that back in the day, and no longer am. But there was the Gemini card, but it was really just about. Yeah, I mean, we do a lot of our payments to our from our clients to our employees to kind of any kind of third party in stablecoins for the last 6 years. We've basically been running this business for 6 years on chain, and over the last couple of years, it's gotten to be obviously as things grow and scale, okay, then you go and do banks and all these things. But in the beginning, it was fully on chain, and it was like, wow, we're running a business fully on chain.
That's awesome.
Yeah, like this is epic. And then all of a sudden this neobank thing came, like, oh, you can spend, it's like earn, spend, save, yield, like this kind of like this big four. And then boom, Re.Pay explodes, EtherFi explodes, Cast explodes, Plasma starting to grow, Tria. There's all these names here. Maybe you can just like unpack like what the neobank bull concept is here. Like if I'm a neobank bull, what am I really like investing in? Or like what am I expressing bullishness on by being bullish Rain, bullish kind of like on the neobanks that it's powering? What is that thesis actually?
What's really been exciting to see is that stablecoin infrastructure has brought down the cost of launching a neobank. Traditionally, you have to sign a partnership with a bank, and it would be large monthly minimums. It would be very difficult to do, and then you would be locked to whatever country that bank is in. So you'd be committed to this large upfront cost, but then also not be able to expand very easily internationally. Now with stablecoin infrastructure, we're seeing a lot of neobanks choose to go stablecoin first, build on top of stablecoin rails, and then day one be able to launch in multiple countries, expand globally, which we think is great for innovation. We now have this Cambrian explosion of neobanks, all with different value propositions, different areas that they're targeting, different consumers that maybe weren't profitable to target before, but now they're going after that. So for us, it's like, this is an opportunity to explore areas that just weren't really able to be explored before because of the limitations in the underlying infrastructure, the inability to scale globally efficiently. So there's now like new neobanks that just weren't possible before. So that's really exciting.
And then from the concept of the existence of the neobank itself, why does the world need this product? Like, why does the world need this kind of non-custodial blockchain based system for banking? Like what is the broader kind of adoption thesis here?
I wouldn't say there's really one answer to that.
Okay.
I think when we first launched, there was one answer, was just, hey, you have on-chain assets, you need to spend them.
Sure.
Now that is the base case, like table stakes. It's really up to our customers to answer that question.
Right.
Because it is like, you have to find your niche. You have to find why is someone going to choose your product. And it's like answering that question is like, hey, why do I need this neobank? So if you're just answering a very blanket question, then I think you're going to end up building a very generic problem that is maybe not going to resonate with anyone strongly enough.
Right.
So what's exciting is that you can actually answer this for a very specific set of customers. So whether it's freelancers in Latin America, or it's high net worth individuals in Southeast Asia, or it's remittances into Africa, like there's just a plethora of different use cases that you can solve and build very specific applications for.
And that's the beautiful thing about Rain, is that it can power all of that.
Yeah.
It's completely technology agnostic. And so, how generalized SaaS went through this whole kind of, like, oh crap, we're in trouble. A vibe coder can code very specific, specialized technology for plumbers in rural Indiana whose customers are single moms at home, right? It's like, bang, I built you this in 2 weeks. It's perfect for you, rather than like, let's say Salesforce CRM or something, right? Would you say that the neobank space is going through a similar transition where, okay, with only so much success can you have in a generalized fashion where it's like, I built this thing, it's for anybody.
Yeah.
There's not a geographical kind of opinionated thesis. There's not a net worth opinionated thesis. There's not a spender thesis, a traveler. There's kind of like little subsets that I'm sure each of your customers are, competing on, but also have realized that there's like more of like a moat and a blue ocean if they kind of focus on one. Is this neobank space going through a kind of a similar generalizable SaaS to specific SaaS kind of thing that AI has brought, or kind of how would you explain the
I think
evolution?
that's part of it. Every technological trend goes through this unbundling and rebundling phase, and I think right now in the stablecoin space, we're seeing this unbundling in parts of it and then bundling in other parts of it. I think in the infrastructure side, you're seeing a bundling of infrastructure providers now offering more of this like full solution. And then on the neobank side, you're seeing an unbundling where you're maybe taking what would have been like a super app that's catering to everyone and then just focusing on, actually, I'm just going to take this one piece that this company does okay, and then I'm going to do it really well. And I'm going to be known for like this one thing.
Yeah.
We're kind of seeing like that unbundling of the stablecoin neobank space where people are going more laser thin, going deeper into it. And that was really when we were starting Rain and kind of deciding to become more of a platform. That was one of our core theses, was that we had the opportunity of just going direct, going B2C and becoming a neobank for consumers. But when we looked at the landscape, we realized that there is really no way that we could be best at all these things. There's no way. We're not on the ground in Mexico. We're not on the ground in Nigeria. We don't know the remittance market well enough. We don't know the freelancer market well enough. There's all these spaces that we're not the best to build the product for that. We felt like we were the best at building the infrastructure and then allowing our customers to do what they're best at, which is solving for the problems that they're closest to.
Yeah. And I think to understand a bit as to why Rain even needs to exist or why neobanks needs to exist, it would be helpful to understand the way that transactions even work. And you guys put out a really good article. I think it was a team member. I forget his name.
Yeah, Connor Dempsey wrote a great post.
Great post. And it basically is like the anatomy of a stablecoin swap or swipe. And so maybe you could just like explain to us how card payments work. I know it's not the sexiest topic, and then how stablecoin card swipes work. I think that'd be helpful.
Yeah, I think there's a few different ways. Like you mentioned the Gemini card and the some of the other exchange cards, which I think are important pieces of this whole space. But when we started building Rain in 2021, it was really important to us to not just solve the maybe superficial problem of making crypto spendable, but also there were so many advantages that we felt that we would be able to have if we could actually build everything from the ground up on chain. So not just being able to make a tokenized asset spendable, but actually the benefits of settlement on chain, balances being on chain like all the time. Like that's really what we try to build, is on the ground, from the ground up, stablecoin native infrastructure. So for us, the way Rain does it, which is not necessarily the way every stablecoin infrastructure provider, every crypto card does it, but the balance, when you authorize a transaction, we're actually checking like on-chain balances to make sure there's enough spending power that the user has. Usually in a traditional fiat card, that would be like bank account, or there would be some sort of underwriting happening.
Right.
In our case, like the underwriting is happening against like assets that are mostly on-chain. And then we would do the authorization decision. Clearing is essentially the same. That's like more of a merchant to network side. And right now, Visa does enable merchant settlement, but that's not something that Rain touches or that a lot of consumers would know or care about. And then settlement. So traditional settlement is always net settlement. So like, let's say you swipe your card for a coffee. There isn't one single transaction that goes from you to the coffee shop. What happens is that your issuer, so like Rain, for example, we would be settling with the network Visa, net of all of our customers. So that includes refunds that our customers have. That includes all of the authorizations that were made and are clearing. That's all like one transaction that we'll be doing daily for Visa. And then on the other side, the merchant has like one transaction where they're getting settled net with the card network against all the transactions. So it's like this batch settlement process that happens traditionally. That happens using the traditional rails that are available to you in whatever market you're in. So if you're in the US, you have like FedWire, you have ACH, you might have access to some other rails as well. Those traditionally only run during banking hours, so Monday through Friday. And then you would have to post collateral with the networks to cover weekend settlement or long holiday risk. Because you're not settling on a Saturday, you're not settling on Sunday, you're not settling on Christmas. But Visa cards are being authorized 24/7. So come Monday morning, Visa doesn't want to take the risk that the issuer on their network isn't able to actually meet the settlement obligations that happen. So they will have most issuers post collateral to cover those days when they're not settling. In 2021, Visa introduced stablecoin settlement, so you can actually settle with the network in USDC. And then we were one of the first to do 365 settlement, so being able to settle in USDC every day of the week. So whether it's Friday, Saturday, Sunday, whether it's Christmas Day, Martin Luther King's Day, we're settling every day. So that actually allows us to collapse some of the collateral requirements that an issuer typically would have to post. So lower cost of capital. Our borrowing needs are a lot lower. So that means we can run programs more efficiently. Hopefully those savings can be passed down into the end customers because the actual cost of running a program are now a lot less.
And so just very specific point on the refund side. That was a big pushback to using crypto for payments was once you send it, it's gone. And I assume you guys are working, very diligently on this. And then if it's not out already, it will be, very soon a feature, because when these guys go and say like, oh, I'm XYZ powered by Rain credit card. Like it's my stablecoin credit card. But when I think credit card, I'm like, I can go take my MX to the club and spend $5,000. And if I don't have it in my bank, I can still spend the $5,000. But it's not a credit card in the same sense. In the same sense that I can, get a refund or spend the money if it's not there, because you're saying you guys are running the on-chain validation or verification instantaneously. What am I missing there, and what's the status of kind of like the refunds?
So there's we support a variety of different types of credit models. Some of it is collateralized. So you'll have crypto in like a smart contract or somewhere where it's collateralizing your credit card or securitizing your card. So that exists in the fiat world where there's like a securitized credit card. Usually that's for like subprime borrowers where they can actually, maybe their credit limit is or credit score is too low and the bank isn't willing to underwrite them without securitizing some sort of collateral. So there's like on-chain equivalents of that in smart contracts. We do have some programs that are not collateralized. So they actually are doing some sort of underwriting and they're authorizing a transaction without some sort of collateralization happening. So we support both models. Like really what we're focused on is the infrastructure, and you can develop different types of programs based on that infrastructure.
And refunds are available with Rain cards?
Refunds are available. We think that a lot of people like to talk about just stablecoin to stablecoin, account to account, wallet to wallet payments. But there's a lot of value that a network like Visa provides in a transaction. Sure. Having this like trusted intermediary in between the transaction. If you're transacting with an unknown party, like you're just walking into a store, you have no idea who this business is, you haven't underwritten this business, you haven't done any KYB on this business, you can take a Visa card, swipe it, have a transaction authorized, and you trust that you're going to be able to get the good that you just paid for. And if not, you can file a dispute for that. If you're sending this random merchant online or in store, USDC, like you said, it's gone, right? And if you didn't get the good that you were promised, you have very little recourse on getting that USDC back. So we think that even in a world where stablecoin settlement on both sides, from issuer to the network and from the network to the merchant, is happening instantly in stablecoin rails, there's value for a network like Visa to provide in that transaction.
100% there is. And I mean, we had Josh Moss, their stablecoin strategy lead here, spoke a lot about the work that they're doing, and they're just really, really pushing into it hard. Obviously, that Open USD announcement that they were a part of. So just kind of getting to Rain, the company, not to be confused with the Rain token that is on the CoinMarketCap right now.
I don't even know what that token is.
I'm sure you guys get asked that a ton. It's confusing. You guys are having this explosive growth. The transaction quantity on Rain cards is exploding. The amount of neobanks launching is also, it's almost like those people have realized that this is a good business model if they have a unique value proposition to a unique set of customers. As that grows, Rain is just the kind of a benefactor of that growth. You guys have had this massive explosion of transactions. I mean, I think the leading card providers are doing $100 million a month of volume, and then like 80, 60, 40. So cumulatively, you're looking at like $250 million or more a month right now through Rain, which is pretty intense, right? I mean, if you look at that chart from in early 2025, it was less than maybe 20 million.
Yeah. I think in 2024 we were. If we did $1 million in a month, we were like very excited.
Right. Yeah, exactly. And so we talked about, so that's that first 10X. Congrats to all the investors who, entered that, saw this early. Great. But the next like 10X for 100X from here is like, now you're talking $250 million a month to like, tens of billions a month. And then you start to get to like the big T, right? And so like, what does that look like? Is it agents? Is it more neobanks? Is it regulation? Like, what does Rain's decade-long like trajectory look like? Give us like the bull case and maybe the conservative case as well, if you can.
Yeah, the growth so far has been exciting. Looking at payment scan, it's awesome to see the inflection. But really, I don't like to pay too much attention to that, because if you zoom out, stablecoin cards are still such a small like speck of the actual volume. Visa's doing trillions of dollars a day, and we're doing like a tiny, tiny fraction of that. So growth is exciting, but when we talk about the TAM of what we're building, we really think about like all of money movement. We feel like there's very few use cases where stablecoins wouldn't improve, whether because it's faster, because it's cheaper, because it's global, because it's more transparent. There's so many benefits to moving money through stablecoin rails. We think that the TAM of this space is actually like all of money, which is a ginormous TAM. And right now we're focused on this space, and also we like to talk about just where we are in the technological adoption curve, right? We're still in this crossing the chasm moment where there's early adopters that have really found success with using stablecoins, and now we're trying to get into the mainstream, and that's really where the next 10, 100x of adoption is going to come from. It's going to come from the Western Unions of the world launching stablecoin products. It's going to come from more and more of these traditional businesses moving over to stablecoin rails. And I think in the US, a lot of our fintech apps probably feel pretty great. Like we don't really see the need to use stablecoins or adopt stablecoins. But I think that's the underlying plumbing that is really what needs an upgrade in the US. It's how do we actually upgrade the way that settlement happens that doesn't rely on pre-funding accounts all over to make it seem like it's instant and magic, but actually doing that, lowering the cost. Like the end user should actually not even know that experience has changed. It should be like your app just upgraded from this cloud provider to this other cloud provider, and you didn't notice a difference, but maybe it's a little bit faster. Maybe they can offer you the service for a little bit cheaper. That is, I think, the dream, is that the actual experiences don't really change. They're just maybe available to more people. They're available in more countries. They're available for a cheaper price. The experience is faster, like all of these benefits, but the actual experiences don't necessarily have to look very different.
Yeah. And so that's the big swing for Rain, is this reinvigoration of the settlement process of spending at large to get to that kind of bigger.
And the bigger space is just, we're trying to increase stablecoin adoption globally.
Yeah.
And if we can just take a small piece of that, like that's great. I think that's going to be, right now we have experiences that we're mostly powering are card-based. We're going to be experimenting with a lot of different experiences that are not necessarily card-based.
Yeah.
We're also really excited about agentic payments.
Yeah.
We have both stablecoins and AI, like two very disruptive technologies at the same time, which is very rare that you're in this like platform shift of money movement and also artificial intelligence. And we don't really know what agentic experiences are going to look like in the future, but I am really certain that agents are going to spend more and more on our behalf. And then those agents are probably going to prefer stablecoin rails if it's an option. I think a lot of times it's not going to be an option because of merchant acceptance, but you're seeing things like X402, where agents now can pay for APIs like using stablecoin rails, and that's like a no-brainer to me. So what are those new experiences that can be unlocked using with AI agents? That's like completely greenfield, which is very exciting.
Yeah. Is this your first time? Are you a first-time founder?
No, this is, I guess, technically like a third startup. I did my first startup in high school.
Okay.
I was building this college admission statistic website. Okay. So we were like crowdsourcing all this data from our friends in high school and then posting it on this like online site that we built where younger classmen can look and figure out what they needed to do. That was the first startup. Then after college, I graduated from Stanford. did a startup on like the contractor management space.
Okay.
So it was in this like gig economy time. So we were selling to rideshare services, like food delivery startups, anyone that had to manage thousands of contractors and onboarding them every week globally. We built software to help automate that at scale. And then we got acquired by Intuit. And I was part of the self-employed team at Intuit for over 4.5 years.
Got it.
Before leaving and then starting Rain.
And is the vision for Rain to potentially be acquired in the future? Is there like what is your kind of longer term thought here? Obviously, folks are going to be, and I'm also curious like how you guys make money and et cetera. But kind of how are you thinking about the more longer term trajectory?
We want to build a generational business. Aspirationally, we want to IPO, become a public company.
Hell yeah.
Don't want to get acquired. Like that's not something that we're actively looking for or interested in. Like we really want to build a sustainable business that can continue growing and compounding for decades ahead.
And what are some of the, if you can share, like what are the, like what has been the growth of the revenue side, and how like what's the margins of the business? Like what are the business lines?
Yeah, main sources of revenue are interchange is a big source of revenue for us. So that's the fee essentially that merchants pay for accepting cards with the card networks. As an issuer, we get a large percentage of that fee. We also charge SaaS fees to our customers for running the infrastructure. And then there's usage fees that we charge as well. So that could be for issuing cards, for KYC. A lot of these are costs that we bear for operating like a compliance program or dealing with like shipping, dealing with disputes. So fees that scale as the program goes. So those are our three main lines of revenue. Growth, I think we've gone from low single digit millions to hundreds of millions in the last like 18 months.
Wow.
Yeah.
So, I mean, another year or two or something, and this IPO is going to be ready to go. I mean, if not already.
Yeah, we'll see. I mean, there's a lot of work to do ahead. We're just trying to build the best business possible, and then hopefully everything else falls into place.
And what's the relationship like with your other founder? How did you guys? I mean, you guys met in the Slack and kind of saw this problem. What's the kind of dynamic between you two?
Yeah, it's been interesting because we didn't know each other before just meeting on Slack.
Yeah,
we had this organic like founder dating experience while working on
no
this.
way.
Well, like we worked on this side project together, which was like low commitment, just for fun for like 8 months. But that was really great because we got to learn about each other's strengths and weaknesses, got to see if we enjoyed working together without a lot of the pressure that comes with putting like a co-founder label on it or raising money and then having to like make things work. And then when we found an idea that we had really strong conviction on that we wanted to actually go all in at, we had this experience of, okay, this is actually a partner that I think would fit for this. Because I think people talk a lot about product market fit, but founder market fit or founder product fit are just as important. So making sure that you and your co-founder are the right people to be building this startup. It might be a good idea. It might be something worth doing, but are you the right people to do it? Is this the right co-founder to do it with?
Yeah.
I think that's just as important of a question to ask. And then we asked ourselves that question, and we felt like, even though we had no experience launching cards, we felt that we were the right people to do this based on other experiences we had. And I think we complement each other really well. Like I'm the CTO, I mostly drive product, engineering, design. He does like all the other parts of the business, which for a financial services business is a lot, right? It's dealing with compliance, it's dealing with legal, it's dealing with implementation, marketing, finance. There's so many aspects of the business that are really important to handle. And if you get wrong, then the business is just not going to work. And if you get it right, then the business can actually like really start humming.
Yeah. What are some of the qualities of your co-founder that you appreciate the most? And what are some of the things that are the hardest to kind of work through?
He's, I would say, very creative individual. Like he just can, any problem, I think he will just find like a creative solution to it.
Yeah.
So it's great working with him because I can just like think, okay, there's like, this is so difficult. Like, I don't know how we're gonna like, get this. Like when we were first trying to figure out how to launch Rain, right? We didn't know anything about cards. Like we didn't even know who we should talk to. We just talked to anyone that would give us a meeting. And then it was really his like creativity that came up with a plan of like how we were going to do what we wanted to do at the time, which felt like a very large task. So I think just his creativity, He's kind of fearless, right?
There you go.
You kind of need that fearless person in the CEO helm. I think I'm a good counter to him in that I'm like the sanity check sometimes. Sure. Like he has a lot of crazy ideas, and I veto like a lot of them, or like, okay, maybe we shouldn't do that. Yeah. But this one is actually like really good, and I think when we both agree on an idea, it's usually like a very good idea. Yeah. So he's able to like come up with like a lot of crazy stuff, and then I'm able to like filter to like, okay, here's like the things that I feel like we should actually do, and then that has been a good combination and partnership.
I'm curious, how your workflows and your productivity and the way you've thought about building the company, especially on the product side, has changed post AI, post Cloud Code, post Cowork, Codex, et cetera. Just give us kind of a sense into how your entire viewpoint on building a company has changed, whether it be the standards you set for your team with using these tools or your own workflows, just like from the viewpoint of, getting acquired by Intuit back in the day for a company that sounded like it'd be a lot easier had you had some coding tools versus now building, the go-to infra for crypto cards. What has changed in your outlook and your personal, flows? A
lot. Yeah, I always think that we're lucky to be building the business at the time we're building it and to scale it at the time we're scaling. In the beginning of last year, we were just 17 people on the team.
Sure.
So most of our growth has come with the assumption that there are these agents and these artificial intelligence that would be able to do a lot of work that traditionally as a fintech, you'd have to hire a lot of people to do. So we can think of compliance, we can think of support, we can think of implementation from an AI first perspective. Like, how do we actually redesign these traditional workflows from this assumption that you have an agent that can do a lot. So that's been great to be able to build into that assumption. Also thinking about what are our competitive advantages as a business. Like my last startup, I think if I would not start that business today because I think everyone would have just built that internally because it would be a lot easier to do it and have it fully customized to the way that your flow works. For us, we're building a startup that I think is very difficult to vibe code. Like you can't really vibe code Rain over a weekend, just because of all of the compliance, the licensing, legal, the relationships that you'd have to build. All those stuff just takes time and experience. So it's also like redefine where we think we should be investing in the business, investing in things that are unique to what we're doing and that can't be replicated, and then being okay outsourcing everything else. So buying off the shelf things that are not really advantages to the business. And then trying to still maintain the team as like relatively lean. Yeah. Right. Not trying to overhire and then having to do a round of layoffs because we realized a lot of these roles can be automated. Yeah. So every person we hire is like very intentional hire. Yeah. With the assumption that we can provide them tools that will give them a lot more leverage. Yeah.
Well, Charles, man, congratulations on the success. I know this is from your perspective, still the beginning. Yep. From the outside perspective, clearly one of the breakout kind of consumer applications of the space throughout this bear. I mean, it's been amazing just to see the pure growth. Give you something to be excited about. And it's, there's a really unique position for you guys where the world's waking up to kind of this concept of neobanks, and you guys are in a great spot of just being able to be the provider. And like the beautiful thing is, as these different types of leaders and founders come on with various skill sets and various ideas of what they want to do, it's just this continuous product feedback to you from your own customers. One person may need a license in the Bahamas and need a special FX, rate there in a specific bank, and another person may need a specific cashback, and like there's just consistent feedback across the whole spectrum. Kind of builds out a more sturdy product for you guys that you can eventually kind of say to anyone, hey, like we can definitely do whatever it is that you need, because I mean, look at all of what we've done. And so I know that you guys are getting there and steadfast on the way to the IPO. So look forward to seeing that as well. And thanks for joining us here, man.
Thank you. Yeah. Thank you so much for having me.
Yeah. Pleasure, man. Guys, we'll be right back with the rest of the show. We're going to talk markets, charts. We're going to look at some of the latest happenings and more. Druckenmiller and PTJ are buying our bags. We have nothing to be upset about. We'll see you guys in just a moment.
we get deep, we get deep, hard. You know we get deep. We get deep, you know we get deep. We get deep, huh? We get deep, you know we get deep.
Yo, what's going on, guys? This is ETH with the Rollup. We're going to be patrolling the streets of New York City, getting answers to the questions that you guys have most. What are people trading? What are people investing in? How much do people actually budget? We're gonna have people from all over, all different investment classes, people who are dead broke, people who are dead whales, people who are just loaded. There won't be a mayor or politician to stop us on the streets. We're going to go everywhere, all 5 boroughs. We're taking over the 212.
We get deep. We get deep. Hard. You know we get deep. We get deep, you know we get deep. We get deep, we get deep, you know we get deep.
Bar chart tells us that the total value of U.S. corporate equity is now more than 400% of GDP. This is double the peak of the dot-com bubble and more than 5x before the 1987 stock market crash, warns JP Morgan. As memory stock ETF DRAM is up a whopping 40 to 50% from the lows. SanDisk flying. The memory trade is looking for another leg up. Yet the total value of the U.S. corporate equity is now more than 400% of GDP. The United States of America is quite literally dependent. The economy of this country is dependent on the stock market. This comparison suggests that U.S. equities have grown far faster than the underlying economy. We are in the middle of the AI build out. Of course, that is what the economists will tell us is the reasoning for this. Some investors argue that high valuations can persist, especially with AI, earnings growth, and more. However, other investors warn that this is getting too out of hand. Whether you think it's out of hand or not, what I think is a certain objective reality is that due to the excess amount of capital in the market, the indexes and the large caps and the hyperscalers are likely to be more volatile and reactive and responsive to external catalysts than they would not be, or than they would be otherwise, meaning Fed rate changes, meaning war, meaning other kind of catalysts have the ability to really turn the market quickly. Investors see their portfolios at all-time highs. They see these swings. There tends to just be a lot more reflexivity when there's this much capital in the system. I think that's the objective reality. More volatility for sure. Whether or not you think it's upside capped or downside capped, or they are overextended or not, I think is a subjective conversation. But as you can see here, we are at a point of very, very, very outsized total capital by means of equities versus GDP in the US.
I'd agree with the volatility take. I think if you look at the stock market capitalization as a function of the productive economy of the US or any other, geographical jurisdiction, typically the way that this has been is like, okay, well, there's a market and it's correlated or connected or based on the productive output of the companies that make up that market. Now what we're saying is that, we've increased the capital supply to such an extent that it's no longer a 1-to-1 relationship. Maybe it's a 4-to-1 relationship, at least 400% of GDP. That is now saying that there is more intrinsic capital in the market than it is based on the actual productivity of those companies, which means that, there's going to be 300% more, self-fulfilling prophecy, intrinsic aspects of the market, more based on momentum, more based on technical analysis than previously before, because, well, these things are all intrinsic to the market. And now the capital is the thing that is leading the market, no longer tied to the fundamental output of these companies. So I think that is absolutely going to lead to more volatility. It's also going to mean that, the things that these prices and these markets are reacting to is going to be different than what it was before, and it's going to be outsized. So I think, Andy, I think you draw the correct conclusion. I think, the one reason for it is just purely that there's more capital and liquidity in the market. But I also think that since COVID, we've been in this K-shaped economy paradigm. And I think that's also accelerating what we're seeing play out in the market and why we're seeing it decouple so much from GDP. And the reason is the K-shaped economy is basically this bifurcation where the assets are increasing, but the prices of certain economies, certain services, certain sectors are falling behind. And so you can see this in, things like, the COVID is a perfect example because everyone went online. And so you saw the acceleration of things like Zoom, Shopify, online shopping, Amazon, all of these things. And then on the other hand, you have the deceleration and the backwards movement of, malls and movie theaters and cruises and these sorts of things. So you had not like one economy moving one way in unison, but you had this bifurcation in the market, and some sectors did well and some sectors didn't do so well. I see the same thing playing out in digital assets, and it feels like the K-shaped economy is playing out all over the world just for different reasons. In digital assets, it's the K-shape because you have the revenue producers and the monetary premium assets doing extremely well. And at the same time, those are taking market share and taking market capitalization from the companies that aren't doing well, aren't keeping up, aren't generating revenue. And so you no longer have this, everything, rising tide lifts all boats paradigm. It's very much a more mature market, and it's very much a market that's just been had so much liquidity poured into it, at least in the equities market, that we are still starting to see those wealth effects, meaning that compounding is still happening. Liquidity is poured into certain sectors of the market. That liquidity is able to compound in those sectors, but it drains the liquidity from other sectors. So you see the liquidity compounding in things like the hyperscalers, in memory. This is the AI bottleneck trade, and it's a compounding wealth and liquidity effect. But you also see the lack of liquidity, and you see that compounding effect also take place in the sectors that are starved of liquidity.
Love it. Love it. Ladies and gentlemen, that is your daily equity. Today's stocks are outgrowing GDP at a rapid ratio. Powered by our friends at Denari. Trade SpaceX on Hyperliquid spot with Denari SPXCD. They also just launched their USA available product up to $5,000 per day for US investors. Trade the entirety of the S&P 500 on chain using Denari. Check out denari.com for more. Ladies and gentlemen, let's get into the revenue durability conversation. Tom Lee also bought more ETH this week. He just keeps buying ETH. I mean, he just keeps buying ETH. I mean, it is hard to it's hard to even look otherwise as to what he's doing. I mean, he just won't stop buying ETH. Another 9,000 ETH added this week. I believe that they announced 9,000. Saylor stops buying ETH, Saylor stops buying Bitcoin, stops selling Bitcoin this week. Michael Saylor is getting pwned by Tom Lee. Whether that's leading to this ETH Bitcoin ratio changing, I think is up for grabs. But it is clear that Tom Lee will continue to buy more ETH week over week. He's now accumulated 13 or 14 times the amount of ETH that he previously had, I think in the first month or two. So he's just been rapidly accumulating. We know BitMine is doing that. And then we know SharpLink is going and deploying their Ethereum in the market as well. Guys in the chat, how are we doing? Little Miss Gunn, good to see you. Good to see you, FOMO, new type. Market looking pretty good, Rob. Revenue durability is the question. Oh, yeah. So, guys, let me take a super quick standby, and we'll be right back with the revenue durability conversation. Alrighty, guys, is durability of revenue what matters? So if you guys remember our conversation from Friday, we talked about whether or not protocols should do buybacks or not, right? We talked about whether or not that matters, why that matters, is it important? And we kind of came to, several different consensuses, but I would say like the crux of it was if the return on equity is higher than the return on your capital, essentially, then you invest the money into the company. If the return on equity is lower than the return on the capital, then you do buybacks. I mean, that is a very, very simplified version. The full episode will be on our YouTube tonight. It's already on X. There's tons of clips. It'll be on Spotify too. Today is about the durability of revenue. And so there was a common rhetoric in the market prior to Pump Fund's recent re-rating that the reason why Hyperliquid was valued so much higher than Pump Fund was because investors did not think that the durability of Pump Fund, i.e. meme coins and trading on chain, was nearly as durable as Hyperliquid's. Hyperliquid expanded into RWA perps. They got a lot of traction, now have a lot of their daily and weekly volumes, as well as open interest coming from RWA trading, stocks, commodities, equities, you name it. Pump Fund went through a bit of a dry spell, if you will, with on-chain trading having a big slump in 2026. However, if you look at the Pump Fund revenue numbers, you'll see that they're actually much steadier than you may think. And so while this is a specific small example, I think there's different ways to approach this buying on-chain businesses conversation. And so today's conversation is about how to think about the different types of durability of revenue and the different types of businesses on chain and how investors are essentially valuing these different types of businesses. Another good example is Sky versus Hyperliquid. Sky does let's call it 1/5, if you will, of the Hyperliquid revenue. You need to fact check me on that. I think it might be a little bit smaller.
Not today.
But
today, Sky is above Hyperliquid in 24-hour revenue.
There we go. So Sky is currently valued at a minuscule valuation compared to Hyperliquid. Why? And why is Pump Fund trading at its valuation due to its business model? And then you got other businesses on chain. You look at Tether and Circle. You look at Circle's valuation in the public markets based on its revenues. And so there are kind of these categories of revenue. And the question is, how much does durability matter? And so, Rob, curious your thoughts.
Why
matters. Is Hyperliquid trading so much more expensive to Pump Fund? Why is Sky at such a lower valuation? Is it programmatic buybacks? Is it token economics? Is it unlocks? Are investors questioning the durability of revenue and then basically not investing or not placing the same valuation premiums as a typical like PDE ratio, right? 12, 15, 18x is what most investors kind of typically expect to see. But why are some protocols getting that or higher, and why are some getting lower when they have consistent revenue?
Yeah. Well, it's going to be a lot of value accrual to the token. So if we segment this first by protocol and token, you brought up Hyperliquid and Sky. Let's just take that as the example for now. Hyperliquid's at a $59 billion fully diluted valuation. And Sky is at a $1.2 billion valuation. Sky also has a $1.2 billion current market cap, so they are fully diluted. Although I think there might be an inflation schedule. And so you can look at the protocol, you can look at how much revenue is coming in, and you can also look at the durability of the revenue that the protocol is generating. And you could say, look, maybe it's the case that meme coin gambling or, let's stick with Hyperliquid and Sky. You can make the case that, rate environment is, high, it's going to stay high. And so the durability of, a stable coin protocol that is, making money on the spread between what they can loan out and the cost of capital, that is going to be fragile, and they aren't going to be able to keep up this level of revenue. And maybe perps is the opposite, and perps is going to continue to grow, and the durability of that revenue is increasing. And so it makes sense that Hyperliquid, the protocol, is going to generate more protocol revenue because, well, it has more durable revenue than some of these alternatives. But then you got to look at the token, and that's a different conversation. And I think the reason why Hyperliquid is valued where it is, which is almost 50 times the valuation of something like a Sky, despite having less revenue today in 24 hours than Sky, the reason being because we know how durable that value accrual is to the Hype token. So you could argue that, you know, whether Sky or Hype has a more durable revenue profile doesn't really matter. The question really to ask here is how much value, how much of that revenue is moving into that token? And then how durable is that? How durable? Let's say, you know, Hyperliquid and Sky continue to generate similar revenue profiles. I mean, today they're within $20,000 of one another. Sky's at $442,000 of 24-hour revenue, and Hyperliquid's at $422,000 of revenue. Let's say for the next 6 months, these guys continue to generate the same amount of 24-hour revenue every day for the next 6 months. But Hype has made it clear to their community and their token holders that 99% of the revenue of the $422,000 that they generate every single day is going to flow into the token. That's an extremely durable value proposition and value accrual proposition to the token. Whereas Sky, you know, they've talked about buybacks. They've said we're going to do buybacks, and they've done buybacks in the past. But it's kind of, it turns on and turns off at their will. Yeah, they've
turned it off as of now.
You got to trust that the Sky team is going to do the buybacks. And so maybe they do generate very similar amounts of revenue. Maybe they even generate more revenue, and they decide to accrue some of that revenue back to the token at some points.
Right.
But how programmatic, how durable can token holders expect their value accrual to be? It's not necessarily, the question isn't necessarily the durability of revenue, but more so the durability of value accrual.
Interesting. Okay, so this piece, I like that take. This piece from that 1816 guy, Delphi researcher type of guy, great piece. When the market doesn't buy the revenue story, there's a question I keep coming back to when screening protocols. If a business earns your entire investment back in under 2 years revenue, what's stopping you from buying it? The answer is almost never the revenue itself. It's whether you believe the revenue survives. That's what the X-Rev multiple, market cap divided by annualized revenue actually measures, not cheapness, durability. And so 2 live examples make the point. Pump and Arrow both screen at low single-digit trailing multiples, 2.3x and 3.5x respectively. Over the last 30 days, Pump is up 87%, while Arrow is down 14.5%. Same screen, but opposite outcomes. In June, the market priced Pump at 1.3x, meaning it doubted the protocol could sustain even 16 months of current revenue. That disbelief broke in July, and the re-rate has done all the work since. Arrow is the mirror image. Its multiple has tripled since the December 2024 price peak, not because anyone believes more, but because revenue is decaying faster than the market can reprice it. If this framing holds, the trade isn't buy the lowest multiple, it's buy the multiple that's about to stop being doubted. When a doubted revenue stream proves durable, the re-rate does the heavy lifting, even if revenue is outpaced. And I think this is exactly what happened to Pump. And that's what I was trying to explain. I think it was like sometime last week where I was like, it's like this trade has been completely ousted by anybody who's an institutional fundamental investor because they don't believe in memes. They don't believe in the ability for this protocol to generate this revenue longer term. But that is what led to this violent price move, this violent move, is that there was this belief switch in the durability of the revenue. And Rob, what you're saying is that, okay, maybe it's not just about that, but it's also about the belief in the market that the token is going to accrue that value, which we spoke about last week in that Pump turned on the programmable daily buybacks and for the last 3 to 6 months. And so that whole, like, what does the protocol get? What do token holders get? That whole question has been effectively taken out of discussion, right? And so they solved the question that, if you pull up the screen again, that the framing is by the multiple. They solved the doubting question, and then the re-rate did the heavy lifting. And so this fella is proposing the XREV stat, which is market cap over annualized revenue. At 1x, the protocol's revenue pays back its entire market cap in a year. Below, it's faster than that, right? And so obviously it's like, whoa, okay, that's a lot of revenue to make. Like Hype would have to make what, 50 billion a year if we're counting that top line number. But effectively, the read is like, is there protocols out there, guys, that we think the market is applying a massive durability discount to, and we can get positioned in these before the re-rating? And that's just what happened to just what happened to Pump. And I think there's more to come. And so basically, the alpha is in figuring out whether that disbelief is right or not.
So let's use an example here.
Yeah.
Fake world assets, FWA.
Sure.
Generates 38 million in annualized revenue.
Okay.
Fully diluted valuation, 31 million.
Okay, so that is going to be in bucket A. Prints $400 million a year. I don't know, feels like a fluke. Price tag 1x. Mm-hmm. So the argument here is the market is once again saying to FWA, like, hey, we don't think your NFT gotcha on-chain casino is durable. Right. That's what we're saying. That's what the market's telling you right now based on those numbers. Obviously, the protocol is so new. So you get like this like kind of like novelty discount as well, because, you know, who knows where this thing's going to be in 3 months. It hasn't even been around for 3 months. Yeah. And then bucket B, no revenue yet, but the ICO says 4 billion, take my money. There's a lot of protocols in bucket B. Right. Our job right now is to find protocols in bucket A. Right. And you just said that fake world assets is literally the exemplary of a 1x price tag, which is it's literally making the amount of revenue per year that its market cap is at.
Right. I like this metric because what it says is that it's a measurement of doubt in the market.
Correct.
And it gives
which is where alpha is.
Right. And it gives you an opportunity to, appease that doubt, and it gives you an opportunity, the market an opportunity to remove doubt from a project. And if the doubt is removed in your mind faster than the doubt is removed in the market's consensus, you get to be along for the ride during the re-rate. And so absolutely, I mean, it's a fantastic example here. FWA fits into bucket A. The market is currently doubting that FWA has durable revenue. That's why it's pricing it at below 1x, this XREV multiple.
Yeah.
And so what this does is if you are, basically in the camp that says a believer, if you will, sure, the market is still a disbeliever. And so now if the market does suspend that disbelief, the asset teleports, and you can be along with the ride if the market, if you suspend your disbelief before the market does.
Correct. And that is exactly what just happened to Pump. And it's still in the process of that re-rating because the revenue is insane. I mean, look, they're not printing what's the market cap now? 3 billion. They're not printing 3 billion a year. So it's, it is now in the camp of, it's closer to like a, I don't know. The price tag is maybe like a 5x or something.
Would you say 3 billion?
That's the FDV of Pump.
So annualized revenue according to DeFi Llama is 325 million.
Right. So you're sitting on you're closer to that 10x price tag now.
Yeah.
But where did this rally start? It started at a bill. So you were sitting at like a 3x price tag, and now we just got re-rated to a 10x. And look, I mean, guys, a 10x multiple on revenue is still nothing crazy. That is still very, very reasonable for any. I mean, this thing could trade 50x revenue.
Exactly. And I think that's an important thing to point out. Like these memory equities traded 30, 40 times. There's
if you got anything
in bull markets, you have 25 to 50x multiples.
I mean, if you make $1 billion, I mean, look at Hype. You make a couple $1 billion $1 billion a year. They're at a 50x multiple, and that thing might trade to $100 before the revenue really changes. So if you got anything in that 1 to 3x bucket and you're a believer in that asset, oh my God, you got to slam that thing, because I mean, that's just what happened to Pump. And so, so bucket A tokens are born cheap. A new protocol, friend. I love the FWA example. here. A new protocol finds product market fit in a high fee sector and revenue explodes before anyone believes it lasts. So XREV starts near below 1x. This was pump in the bear market.
It's also FWA now.
Correct. High revenue, small market cap, maximum doubt. The market cap is low for exactly one reason. The market isn't buying the revenue story yet and makes these the belief re-rate candidates. Bucket B are born expensive. The market prices them from day one as future revenue giants. So XREV starts with a belief that they already paid for. There's no doubt to buy there, only expectations ahead. Arrow launched in bucket A. Pump launched squarely in bucket B. Watch what happens to each in the following sections below. Bucket B pays back its premium. Yeah, it launched at a 4 bill val. More than 9 years of the revenue of protocol was already printing and opened up at 4.5x on circulating supply. The belief was prepaid. The market spent a year taking it back. Reasonable at the time, meme coin volume cyclical, competitors were vamping it, and its durability discount, it started at like a 6x, right? But they say it peaked in June, right? In terms of it got all the way down to 1.29x in June. This thing was the screamingest buy in June. And I can't believe we didn't like add more into it. I mean, I got into it on perps, which is great, but I just, for the same reason that like the whole buybacks, you own more of the network at the lows. Like you just want to own spot in these things. Because your share of the network increases as the burn happens and as they generate revenue and take supply off the market. This thing was trading at a 1.29x, Rob.
Yeah.
And if we're saying that hype is at a 50x right now, again, depends on how you navigate the hype market cap and tokens and yada, yada. Anything in this one, it's currently only at a 2.3x right now, which means that somewhere our math is wrong because you're telling me that it's at a 3 bill FDV, and
yeah, I'm telling you that the annualized the annualized revenue on DeFi Llama is 325 million.
Right. Well, then maybe I got the FDV wrong because they did a massive supply burn.
I see Pump Fund at a $2.3 billion valuation.
That's what I mean.
FDV.
Yeah. So it originally started 1-to-1, but they burned 36% of supply.
Yeah.
Yeah. So okay. Yeah. So it's trading at a 2.3x right now.
Okay. Yeah, which is still relatively low.
So when they burned the supply, the step down in this ratio took a massive elevator down because they didn't burn any revenue. They're still generating the same amount of revenue, right? Exactly.
And so the denominator stayed large because the revenue is the denominator, but the market cap, fully diluted market cap, is the numerator, and that got a massive step down.
And then this is what they did. This is huge for FWA. If FWA does this thing flies to multiple hundreds of millions of dollars. So my only concern with FWA right now is roughly $370 million worth of circulating supply burned. Bullish.
This is pump.
Then they lock 50% of net revenue into an irreversible buyback and contract running for a year. This is what changed my mind on Pump and completely changed the trajectory of their chart.
And I want to jump in here because this is exactly durability of value accrual. Everything we've talked about up until this point is durability of revenue. You could have had a problem, or the market did have a problem with Pump Fund at 10x. The meme coin, gambling, casino wasn't going to last.
Yep.
Right? This was the institutional cycle, and Pump Fund in this positioning didn't really make a lot of sense. Their revenue was going to decline. It was also cyclical at the time. Turns out that was wrong. But the difference between that conversation and this one is value accrual versus revenue.
Yep.
Value accrual is the amount of that revenue that is going into the token, and that is just as important, if not more important, than the revenue itself. And so let's keep the screen on the screen.
Yeah, because this is exactly what you're talking about, where the earnings now convert directly into a bid. And this is what we need to see for FWA. And this is why Hype was valued way higher than Pump was. And this is why Sky is also not valued nearly at where these guys are valued at, because their earnings do not convert directly to a bid. That is exactly what you're saying is the main topical nuance. It's not about the durability of the revenue. It's about the durability of the returning of that revenue to the token holders is what the market is pricing right now. And that is exactly what the data is showing.
Yep. Exactly. And look, we have the ability, because these are on-chain companies, these are on-chain protocols, their revenues generated on-chain. All of this can be automated. It can all be programmable and programmed directly into the company economics themselves. There's no reason, if you're a company with a token and with revenue, to not make your buybacks programmatic.
Totally agree. And this is what the market wants. And I love, and I do not mean to keep shilling a low market cap fake world assets, but if fake world just comes out and is like, hey, we're going to turn buybacks on 50% or whatever it is, I don't even know what it is. Can we ask Grok let's find out what token situation going on over there? This is a great conversation. Thank you, Bowen and Cool. Glad you're enjoying. And so the re-rate only started when the revenue story turned, right? So April 2026, and then they had this 50% of revenue locked. I didn't even realize this, guys, until like a month and a half ago. I was late on the ball on this. I should have been all over this, and we should have been buying pump much lower.
And I think, look, the one important thing here to mention is that the XREV metric on its own would have still been that 1.2, but it wouldn't have been a screaming buy until they changed their programmable buybacks.
Well, yes. Yeah, exactly.
That happened to coincide
that all happened at the same
with
time.
just around the same time as the revenue multiple being there. And that takes this thing from a 1.2 multiple with no real guaranteed token value accrual to a 1.2 multiple with guaranteed buyback dry powder programmed directly into the smart contract.
100%.
Durable revenue durable revenue, somewhat of a question mark, but extremely durable value accrual.
100%. And that's what you see here. And so, the author goes on to write about how the re-rate started when the revenue story turned. Big August 3rd to 9th was big fee, 5 million of buybacks, yada, yada. And then XREV has expanded now from 1.29 to 2.3x, carrying pump up 87% in 30 days to a $1 billion market cap. Not even FDV. We're just looking at market cap here, Rob. We're not even looking at FDV. And so
that also might have been the reason that our numbers were a little bit different.
He's saying that he's using circulated market cap on an FDV. The multiple is about 5x, and August unlocks are actively converting one number to another. Meme coin launchpad is still cyclical, but whatever the buyback, blah blah blah. And so then we get to Aerodrome, which is on paper, Aero looks like a better deal. $400 million market cap against $116 million in trailing annualized revenue, 3.5x, and unlike most protocol, 100% of that revenue flows to VE Aero lockers, real yield, zero leak. The XREV chart tells you something different though. It's rising for the wrong reasons. So the multiple has tripled since December 2024, with price peak as revenue falls faster than price. So basically what's happening is early 2024 is Aero. It started quite low. There's a lot of disbelief in it. And the bull case for a new protocol found product market fit, riding basis breakout, revenue exploding ahead of belief, and the market briefly pricing it under 1x, all under 1 year revenue. So it was under this 1x when it launched. And then it's kind of stayed in between this mark, but now it's trading all the way at 8.8x. And so revenue scaled, belief followed, and the multiple expanded to 3.4x in December. And, buying early on was the trade. But now the token has fallen significantly, bear market, of course, and the multiple has nearly tripled to 8.8x, which means the revenue is collapsing faster than the price. Annualized run rate revenue has gone from $443 million at the peak to about $46 million today. Quarterly gross revenue peaked at $106 million and printed $29.3 million in Q2 26. So the revenue as a construct from the peak has gone down significantly. Obviously, bear market for on-chain trading. You can expect this to turn around. Aerodrome is a great protocol. They've got their Aero launch coming up.
I'm also seeing Aerodrome annualized revenue at $113 million. So I don't know where this author gets 46 in annualized revenue. There's multiple
DeFi
data
Llama
sources
here.
DeFi Llama. Well, I mean, maybe this is just extremely volatile.
These annualized, yes. It has gone from 443 at the peak to about 46 million today. Quarterly grossed. But yeah, it doesn't make any sense. If their quarterly revenue was 30 mil in Q2, then how is their annualized 46? It should be closer to 100 mil.
That's what I'm seeing online. It's about 150 15.
Yeah, I mean, that doesn't make any sense. So yeah, this is wrong. Okay. Unless we're missing something. But either way, like the point remains here, guys, and we don't need to go too deep into the exact, protocols and teams and things. The point here is that, a protocol like Pump or FWA, they have this really large disbelief of the revenue. And then there's other protocols that have a lot of belief in the durability of the revenue. You add in kind of like the belief in the distribution of that revenue to the token holders, and you get a picture that's telling you quite clearly, where there's opportunities to invest at the disbelief of the market.
Right. X Gold in the chat says we need more protocols that benefit the token holder like the ones you're discussing. I think speculation is dead, and once clarity is passed, only a few will survive that generate real revenue. X Gold, I think you're absolutely correct, and I think that's exactly what we're talking about here. You nailed it, and I am going to call this the K-shaped token economy, which is the bifurcation in tokens, those with revenue in their protocols, and it's very important that there's an and there. You can't just have revenue in your protocol. You also need to accrue that revenue and value into your token. Those are going to continue to do well. Those are on the up and up. The asset holders, the token holders, the investors into those protocols are going to be extremely happy with their performance over the coming weeks, months, and years. The flip side is that there are companies and tokens out there. One, there are companies out there without revenue, and they're going to need to shape up and find product market fit fast. Two, there are companies out there that have revenue but are not accruing that revenue to their token. Maybe they don't have a token, but maybe they have a token and an equities corporate structure, and they're choosing to accrue that revenue into the corporate structure rather than into the token. The investors into those tokens are also going to be very unhappy. They're going to be very unhappy with the way, because they have the bottom part of the K. And so obviously if you picture a K, you got the vertical line, and then you've got, one line going up and one line going down. The line going up is the revenue generating protocols with value accrual to their tokens. The line going down is the bifurcation and the companies that don't have revenue or are not passing that revenue back to their tokens. There's a very, very, very few select coins that have a monetary premium. We've talked about them, Bitcoin and Zcash, that belong in, those are sort of a separate conversation. But if we're looking at the altcoin complex or the token economy, there is clearly a trend, and you can get on board now, or, you can realize this later. And I think, we speak to not only the individual investors, but also the founders and builders that are in charge of their tokenomics. And I think we're continuously seeing companies, protocols that are seemingly finding themselves in the bottom bucket, right? Maybe they have revenue, but maybe there isn't a buyback mechanism or value accrual mechanism. And they are making changes. They're turning on, programmable buybacks in the case of Pump Fund. We had Lido come on and say that there's, going to be a buyback mechanism. We had, we've heard from Chainlink, they have these buybacks as well, right? There is increasingly a story of revenue turning into value accrual for the token. Companies are realizing this. More tokens are realizing this. Yeah. Now's the time. Because literally, if you picture a K, you can now switch sides. Now is the time to switch sides before these two things get so far bifurcated that you can no longer go to the place where you want to be.
Look over here, guys. First of all, only caveat is like things like Bitcoin and Zcash don't have to play this game. You just got to have a long-term mimetic belief that, one Bitcoin and one Zcash will be higher in the future. No revenue needed. Those are my favorite. This is my favorite barbell. It is SOVs. Yeah. Just BTC, Zcash, unlimited ceiling, lower floor in the bear, volatile as hell, gonna shake you out, gotta be a max believer, vault those things. Zcash is gonna 10 to 20x in this next cycle. I think Bitcoin's gonna go to 250, beautiful run, right? Awesome. Everything else is, it had better be a app that is making money and that is doing well, because it is not going to, your average L1, L2 infra, whatever it is, I don't really care, because if it's not a SOV or if it's not an app printing cash, to me, it's not that investable. And so I don't mean to be so cruel and just like blunt on the nose, but that's the reality. Now back to the screen. The tokens worth hunting are the ones sitting in bucket A, profile today. High verified revenue, compressed market cap, and more importantly, a market that hasn't bought the story yet. The market that hasn't bought the story yet. That's a starting position where the re-rate does the work for you. For what it's worth, a lot of the newer revenue plays are sitting in bucket A right now, printing 6 figures a day with XREV stuck under 1x. The market is calling it all a fluke. Same as it called arrows at 0.7 and pumps at 1.29. Those are our big plays, guys. So as you know, Hype, Bitcoin, Zcash, Lighter, Near, a lot of the client and sponsor tokens, Zama, Frax, et cetera. These are our long-term plays. We've got our fund investments, the EtherFis, and a ton of these other ones that are, hopefully going to play out well in long term. But, I added Pump Lower. And I think that's going to I'm still long on it. I think that's going to do well. EtherFi, I think, is maybe one that I would love to get a look at the XREV. Fake World Assets is one that I think we should probably get in with size. I think Rob needs to get his 30K filled because this thing could have a re-rating similar to Pump. It is these bucket A, market is not believing in the durability of the revenue under 50 mil market cap, under 100 mil market cap. Market doesn't believe that are going to absolutely rip faces off because they're fundamentally aligned with the entire trend of this cycle, which is this kind of, honestly, the entire trend of this cycle is revenue meta. I mean, we were 18 months too early. And this is it. We will find these on the show, guys. And I think it would be doing us a disservice to not just go into FWA here and just look at it a bit more closely.
Since you mentioned EtherFi, obviously a good idea. Ventures portfolio company here. So DeFi Llama, has different levels of granularity, but annualized revenue is 50 million. Fully diluted is 500 million. So you got a 10x XREV. If you're using fully diluted, the market cap of EtherFi is this thing? No way, this thing's fully diluted.
Yeah, it is. It's fully unlocked.
Wow.
Yep.
Okay.
Yep. Fully unlocked. So it's
market cap is right around 500 as well.
So it's about a 10x. So
about a 10x.
So
now I want to mention one more thing though before we start drawing conclusions, because on EtherFi in particular, DeFi Llama doesn't have this for all the coins out there. But they do notate holders revenue here. It's a separate line item. So now we're starting to get into, the top of this is obviously the revenue durability and the revenue multiple. But then the next level in here is, the value accrual durability and the value accrual multiple. And that is where DeFi Llama delineates this between revenue and holders revenue, which what we're saying is revenue and value accrual. These are essentially one and the same, as long as you demarcate the difference between revenue and value accrual.
Yep.
EtherFi has about a fourth of its revenue actually flowing into token holders.
Yep.
So this is something that obviously we want to see this get, a little bit more, closer to 1-to-1. But if I know Mike and the team, we know that they're still spending on growth as they should be. And so this is, again, part of the conversation that we had. And I think we had this conversation on Friday last week, which is that, look, this entire industry is still so early. Like, we're shaping up for a whole new cycle. These payment companies on chain, tokenization, tokenized equities, payments, like these things are just, they're years in the making. And so, we know that this is a company that is going to go out. They have a low cost of customer acquisition. They're extremely focused on the fundamentals, and they're going to use some of their revenue to go acquire more customers, as they should be doing. And I think EtherFi is actually a really great case study to consider how much of that 50 million should they be putting into buybacks or should they be putting into growth. I mean, the conclusion from the last conversation was that a lot of these companies have launched tokens too early. Maybe that's true, but now that the token is out there in the wild, how much should that split be? I think that's still an open question.
Alrighty, guys. Kind of closing out here. Great segment. Enjoyed. Quick check-in on the market. Bitcoin 64.4. Great candle. Needed it, to be honest, to keep the hopes and dream alive of not getting the one last hurrah, but still is potentially on the cards as always. You got Hype here with Druckenmiller entering. Looks decent. I mean, it's just chop city. Link had a nice breakout here from the lows, right? Really nice move. you would want to see this continue to find some support here on this previous level, hold the line there, continue to move. Lighter, same thing, just kind of chopping around that level that it was at. More consolidation, would love to see that continue. Near as well, just kind of slowly, just kind of finding its next level. It should have some really good support here at this level. I mean, this is the original breakout point. It's almost retraced the full kind of like, you could call those inefficient candles. Pump, as you know it, I mean, we were looking in the earlier days to basically flip this level here. That's what it did. Now it's gone up significantly. This is probably a logical place for a pullback, at least of some sort, right? I mean, we'll see what happens in the shorter term, but probably a logical pullback spot, or at least take a break and take a breather and normalize a new kind of range of price in this high, 2/10 of a penny range. ZEC, I mean, my chart is disgusting on this. Sorry for all the nonsense, but had this little triangle kind of trying to break out, still super volatile. Kind of hard to do TA on this thing. You just accumulate this thing and keep hanging out. PURR, Druckenmiller's buying PURR. I mean, we had these two levels listed. Bottom one got hit, bounce. Long ways to go to get back up anywhere close to where it's been. Good start at the very least. Still underwater on that one. Frax, start tracking this. It's got a ways to go on price-wise. Needs to flip. I mean, really, it needs to flip this level. Needs to flip this 40-cent level to be interesting technically and to really be able to get a nice bounce. Waiting to see that. Zama, if you guys missed this, as you guys know, friend of the show, we're getting a really nice retrace here of the breakout level. I mean,
oh, wow.
I mean, pretty much as good. I've been DCing it on FOMO. You guys can see that there on my FOMO. About as good of an entry you can get if you believe in privacy, if you believe this wasn't just a fluke and that we've started a new trend here. It almost looks like the PURR chart. Like slow rise, big breakout, full pullback. Slow rise, big breakout, pullback. You would hope that would be a nice point. Aerodrome, we just spoke about, just consolidating still, had that nice breakout. Got that, you got that news coming next month for their launch. We'll see what happens there. That's the main ones that we're tracking.
So let me tell you about FWA.
ETH real quick, looks great.
Sure. Nice.
Flip this level, really important level to flip here. It did. You can even pull that up a little higher and say, you wanted to see this whole thing get flipped. It did. Any retest to that 46 level should be a good buy. And then, I mean, if we're tracking this thing, we're looking to come tackle some of these highs up here close to $1. I think it's got, I think it could tackle, come up and touch this little level here. So that would be the next target for EtherFi. I mean, all in all, it all depends on the king. And I mean, if this is a flip of a level, then we can push.
All right, guys, that's enough technical analysis.
We need a full flip.
Tell
us about
me tell
FWA.
you a little bit more about FWA and the way that their value accrual has worked.
Yeah, let's put Solar up here. Let's
Let's so there was a controversy in FWA. Value accrual was not going to the token. They generated about, gotta get the glasses on for this one. They generated about 2,000 ETH, and 0% of that went into the FWA token. It was also a nasty timing issue. The controversy hit exactly as the 15-day FWA emissions were ending. So 30% of the supply had just been emitted. Those recipients could now sell, and the extraordinary incentives that had driven protocol usage were disappearing, meaning that a lot of that revenue didn't actually make it into the token at the same time that you had all these token unlocks hitting. That has now changed. And so FWA launched with a 15-day incentive mining period. 30% of the entire supply was distributed to users during those days. And during that time, it was about 2,000 ETH that the protocol generated. Then those emissions ended. But during that time, that 2,000 ETH, almost 0% of that actually went into the token. And so it went into different, service providers and things. One of which being TokenWorks, and they reportedly held 0 FWA. Then on August 3rd, Immediately before FWA became freely purchasable, TokenWorks announced the new long-term tokenomics. 50% of its share of future protocol fees would go toward FWA buybacks. The critical word was future. None of the roughly 3.2 million already generated during the incredibly profitable launch period was going to FWA buybacks. And so that meant that of the $3 million or 2,000 ETH or so that the protocol generated, that's not going to buybacks. But going forward, we're going to see more of the revenue go into buybacks. FWA dropped incredibly after that happened. And so now the response from TokenWorks, which is the entity behind FWA, they increased the allocation from 50% to 80% of future protocol fees going to FWA buybacks. This means it goes into a reserve. That reserve is used exclusively for buying back and burning the token. So since they've gone further, as we just discussed, the current configured protocol fee allocation is 100% towards buybacks rather than 80% compromise announced during the controversy. So instead of just distributing that ETH to FWA holders, they're going to be using it to buy the token and burn it. Protocol prints money, and it is going into value accrual for the token. So there's really no reason not to go into this. I had ChatGPT actually go into Etherscan, look at the contracts on a pretty high-powered model here to verify what we're talking about. And that's what we're seeing. So the first 2 weeks, the protocol printed ETH, about 2,000 ETH. That didn't go into the protocol, or excuse me, didn't go into the token. However, now going forward, if the protocol continues to print, the token will be the main benefactor of that revenue. So not only did you have, and I think this is the clearest example, because you had, at least in the first, you actually have both sides of the thesis, this entire, revenue value accrual bifurcation that we've been talking about. You had this play out in the same asset both ways in a matter of a month, meaning that the first 2 weeks, the protocol printed revenue to the tune of 2,000 ETH, but none of that made it into the token. Then 2 weeks later, the emissions ended, the protocol still printing, but they turned on 80% or 100% buybacks, meaning that there was actually a value accrual thesis. This is represented on chain. Now, my clanker here says that the contract isn't immutable, and that is something to note. Obviously, you would want this value accrual to be in an immutable contract, but it is an on-chain programmable, programmatic value accrual thesis where, first 2 weeks of the protocol, 2,000 ETH, none of that actually ended up accruing. But now going forward, the protocol is actually printing revenue, and that revenue is making its way into the token. That's an extremely important delineation. And now I think FWA actually, has the correct mechanics for token holders.
Gotta love it,
30-day
Rob.
fees, $10 million, 7-day fees, $500,000. I mean, it's
beautiful.
It's printing. It's printing, and
All right.
Market cap's around 30 mil.
Go from 30K to 1 mil.
1x.
Go to 30K from 1 mil on FOMO next year. Let's run it, dude.
I mean, I want a million units. I want a million units of
guys thinking in
FWA.
units. So bullish. Guys, one last thing I want to show you, and then we'll close it out here. Third assistance fund has been activated on Hype. That is BlackRock this time. BlackRock has filed a massive purchase of PURR. They are now the biggest shareholder of PURR itself. So 8 million shares were bought during the quarter ending on June 30th. So they did buy PURR. And Ken Griffin, Citadel Advisors, our old Mr. Kenny G.
He liquidated Leopold and then went all in PURR.
He also added to PURR in Q2. And Druck. So when I sat down with Mr. G's daughter at East Village Cafe, must have gotten to her head. She must have told old boy.
You were hype pilling her?
She must have told old boy Kenny G.
W's
He needs to start allocating to the Gamma Squeeze. All right, guys. That is it for today. As always, love you. Thanks for being a part of the group. Thanks for being a part of the journey here. What are your thoughts on Celestia? They got a long way to go. Still cooking. One time before you guys go. Yeah, I mean, I think we still hold our position that we invested in the fund. It was at a much higher entry. So for what it's worth, we haven't sold, and we hope to see them do well. The era of the space has changed a lot, and I think they recognize that, and so I think they're trying to basically build and dog food their own amazing underlying tech to build basically like revenue generating applications. I think they're doing some cool agentic stuff as of late, but I haven't kept too much tabs on them. But would love to. I haven't talked to Nick in a while, but I was supposed to get out to Hawaii and hang out, but it's kind of been a busy summer, more responsibilities than I expected. But guys, as always, thanks for being a part of the show. W's in the chat. Amazing show. As always, you know where to find us. Today is a green day. It's not always a green day. Sometimes we get red days. It's all right. We're going to be here. We're going to find the most durable revenue assets that are trading at underappreciated valuations. And we're going to continue to show them to you guys. We're going to keep buying them on our own. Robbie's trying to turn 30 G's into $1 million on FWA. I think I'm going to join him on it. Why not? What if the boys turn 30 to 1 mil in public on FOMO?
Shout out G Money.
And we're not even early on the damn thing. The thing was trading at less than 10 mil for a while.
It's been out a month, but like we just talked about, the first 2 weeks the protocol printed, but none of that made it into value accrual for the token.
Do you think?
And then on August 4th. They switched the protocol mechanics, or excuse me, the token mechanics, and started to direct about 100% of revenue into the token. So this thing has only been investable for about 2 weeks.
Yep.
Yeah, it's been out
Still
a little
early.
longer.
W. Luca Flex, thank you. Black Crypto Soprano, thank you. Miss Gunn, thank you everybody. If you're still watching on YouTube, drop us a like, drop us a subscribe. We're live every day from the financial capital of the world, showing you the way, explaining what's going to happen this next bull cycle, participating in the upside with us and the downside sometimes. Yeah, guys, I mean, you guys make this possible. We really appreciate you guys tuning in and being a part of the show. Much love. See you tomorrow, 12:30 p.m. Eastern. You know where we'll be, bullish or bearish, red or green. We'll be here with a smile on our face cooking. See you guys.